Hi everyone, today we'll talk a bit about inflation and mortgage rates and what they have in common. At first, the two are totally different, but totally separate. But that's not quite the case. It turns out that mortgage rates respond directly to consumer inflation, so they do have a lot in common. You've seen this happening in our real estate market and economy. As the inflation has gone up, so have the mortgage rates, vice versa. As inflation goes down, mortgage rates also decrease. Let's talk about why this happens. When inflation gets out of control, the Federal Reserve will raise consumer interest rates to decrease the amount of consumer spending in the economy. The idea is when spending goes down, inflation will also decrease. This is what we've seen over the past year. As inflation increased, the Federal Reserve started rising those interest rates, which they had slashed initially a couple of years ago in the economy. You could see the relationship here. Increasing consumer interest rates is a way for the government to put the brakes on inflation by curbing that consumer spending, especially for large purchases like real estate. But there's also another side to this. When inflation goes down, interest rates will follow and also decrease. We know inflation will eventually be curbed primarily because of the interest rate increasing the Federal Reserve has made over the past year. With that in mind, we also know that interest rates will follow and will decrease down the line. The only question we have is when will they decrease? We can't predict the future and no one knows. So when it comes to buying a home, it's essential to go by what's suitable for you and not by trying to time the market. If you want to see if it's the right time to buy a home, feel free to reach out and I will get you the facts.